Forex rates or rate of exchange is the rate at which one currency is traded with another. This rate depends on many factors, which has a bearing on the supply and demand of currency. Some of the macroeconomic factors which impact currency rates are inflation, interest rates, current account deficits, imports, exports, debts, etc. Each of these factors, either singly or in combination, will either strengthen or weaken the currency. Having said that, let's view the prognosis of the rupee in the near term and in the long term. Hi, welcome to Think and Link series. I'm your host Srinivasan. In this episode, I'll be taking both a short term and a long term view at the rupee dollar exchange rate. First, a look at the macroeconomic fundamentals. A quick look at this tells you that India's GDP growth in 2023-24 is estimated at 7.3% per annum compared to 7.2%, which was a year ago. Now, India's growth rate is projected to remain strong at 6.5% in both 2024 and 25. While India's growth story will play a very important role in the strength of the rupee, the external balance sheet of the external balance sheet of the country would have a seminal outcome on rupee USD exchange rate. So let's have a peek on the external sector. Now, here are some figures which would buttress our view that rupee is going to strengthen both in short term as well as in medium term. The finance ministry expects the CAD, that is the current account deficit, for this fiscal to narrow to 1.3% of the GDP. And this particular revision in figure was after the January trade deficit figure, which was released. It was found that the January figure was 17.5 billion USD, had eased down considerably to a 9-month low. CAD for 2022-23 was about 2% of the GDP. And this year, it's going to be 1.3% of for this fiscal. And for the next financial year, it's going to just increase by another 0.1%, that is at 1.4% of the GDP. So on the current account deficit front, India is pretty cool. Now, here is a more optimistic take on the EXIM trade. Now, the figure which I just reeled out a few minutes earlier was from the finance ministry. But the Singapore-based bank, DBS, has crunched even better numbers. It went a step further and projected this year's CAD to be under 0.8%, citing strong service exports and declining good imports. It has said that benign commodity prices are a key factor in softening import cost, and CAD for 2024 and 25, that is the next fiscal, is going to be around 1.1% of GDP. And these are all very good numbers. Not only that, DBS expects the balance of payment to clock around $45 billion surplus this fiscal. And if you remember, last fiscal, there was a deficit of $9 billion. And the next year, that is for fiscal 2024-25, it's likely that our balance of payment surplus is going to be around $35 billion, a fairly good amount of resources. Now, another thing is from a record trade deficit of 264 billion US dollars in 2022-23. I'm talking about 2022-23. The trade deficit has narrowed to $235 billion. Almost it has come down by 10%. While the service exports has notched up a 7% growth to hit a record of $345 billion. While, of course, service imports has actually come down. And therefore, we have what is called as a service trade surplus of almost $171 billion. Now, DBS expects that the inclusion of Indian government bonds in the global indices to boost inflows. And the BOP surplus, that is the balance of payment surpluses for 2024-25, will pick up in the investment flows. And therefore, there could be a slightly wider CAD, that is the current account deficit. But nevertheless, the BOP surplus will be around $35 billion, as I told you earlier. Now, keeping this aside, there is another important development that took place a few days back. United Arab Emirates, that is the UAE, has exited from the grey list of FATF, that is the Financial Action Task Force, nearly 2 years after its inclusion. UAE was included in the grey list of FATF in March 2022. Now we need to know a few things about Financial Action Task Force for a better understanding. The Financial Action Task Force is a global money laundering and terrorist financing watchdog headquartered in Paris. And the grey list that we are talking about is a list of countries whose jurisdiction are under increased monitoring by this agency. And the consequences of being in the grey list are many. So let's see what are the consequences. First is the raised risk profile for that country. And when your risk profile is high, definitely there is going to be reduced attractiveness of that country as an investment destination for foreign direct investments. Secondly, there is going to be increased cost of doing businesses for entities domiciled in that country due to enhanced vigilance, right? There is going to be enhanced due diligence for such entities which are domiciled in this country. Thirdly, the entities which are there are going to face increased cost of funding. Now, the removal of UAE from the grey list means what? It would open investment opportunities in India for investors in that country who are currently facing quite a lot of restrictions. UAE will now be able to invest in India. They can invest in PEs and VCs, that is the private equities and venture capitalists, and they can also invest in financial services sector. Likewise, India-based PE, that is India-based private equities and venture capitalists, can invest in portfolio companies located in UAE. So, the exit of UAE from the grey list will lessen funding costs for UAE-based banks. And not only that, it will further enhance money coming from other countries, a portion of which could come to India as a portfolio investment. So this could lead to potentially a significant cross-border investments. Currently, USA, Singapore, Luxembourg, Mauritius, and Ireland are the top 5 FPI regions for India. With the UAE exiting this grey list of FATF, perhaps UAE could also join this particular list and become one of the top 10 regions for FPI flows into India during the next 2 years. So both these developments, namely the DBS report, the UAE's exit from grey list, and also selected macroeconomic metrics, point out that dynamics are positive for Indian rupee. There is a room for rupee to strengthen in short term and medium term. And rupee strengthening would have a cascading effect on the exim trade by lowering the import bills, and also boosting investments. So, to conclude, here are the five important reasons for rupee to strengthen. Narrowing current account deficits, not only this year, also next year. I mean, not only this fiscal, also the next fiscal. Higher investment flows from UAE, with whom we have already had a signed trade agreement recently because of exit of UAE from the grey list of FATF. Inflation in India is very much within the targeted band of RBI. India's retail inflation, which is measured by CPI, has eased to 5.10% this January from 5.69% in December 2023. And according to IMF, it is expected to go down to 4%, which is the RBI's targeted rate. India's growth story, being the only major country to log in growth rate at 7% this fiscal and 6.5% in the coming two fiscal, is another wonderful card and points it to be an investment destination for all funds which is seeking higher returns. All macroeconomic factors are positive for rupee to strengthen by at least 1.5% to 2% in the medium term. Unless RBI intends to keep rupee in a predictable and stable range, limiting the potential sharp upside in the rupee is going to strengthen. And rupee could be trading at 80.50 to 81.90 to a dollar. The only downside risk that I see currently is the turbulent disruptions to the trade flow through Red Sea. This could play a spoil sport. Otherwise, things should be fine. Otherwise, things should be fine. And thank you and see you very soon. Till then, ciao.